All right, it is that time, ladies and gentlemen. Welcome to the September 21st version of the Fats and Fuels webinar. Feels like a while since I've done this with you guys, so happy to be back. Let's dive right in. So I think the last time I did this, I said didn't think that soybean oil futures could trade below 60 cents for an extended period of time. And of course, then they just promptly dropped right below that level. That said, I still think that that the shape of our forecast is probably right. I think there could be some continued weakness between now and basically when we know more about what the Brazilian crop size is going to be. Brazil should expand acreage again this year and should produce another big crop, barring any weather issues, and that's likely to weigh on soybean futures, and conversely that should drag down soybean oil futures potentially. And we will adjust sort of going forward. I still think, you know, that 60 cents is a good price for the long term, and potentially above, especially sort of post March. We're updating our quarterly outlook report, which if you don't know what that is, it's a 10-year forward forecast for all of the vegetable oil or all of the renewable fuel feedstocks, with balance sheets and price projections. And part of that is looking at the capacity that's coming online, and really starting in March, we get a big surge in capacity that looks like, if all of the companies that have announced, or even all of the companies that we think are likely to, we kind of assign a probability to these things. If all of the companies that we think have a greater than 50% chance of opening actually open, then it looks like capacity basically doubles at least, between March and the end of 2022. So it's difficult for me to see how soybean oil prices can stay at the current levels, given that we basically have tested the limits of what the fats and greases supply can do already, I think, and I think that's kind of reflected in the price, in those prices. They do have a bit of a lag, and they have come down off the highs that they set in early September. But I think that what you've seen, particularly for biodiesel, is a reduction in the use of soybean oil over the last several months, and I think that has pushed as much of the supply, or nearly as much of the supply of fats and greases into renewable fuel production as is possible. The U.S. will grow another crop next year, obviously, and that may improve the balance sheet a bit for soybeans, but I think there's still going to be pretty significant constraints on not only crushing capacity but also refining capacity. And if you look at our balance sheet for 21-22, we have, again, we still have biofuel usage in 21-22 well above where USDA has it, and they cut their forecast again last month in the WASDE report. I think that there's a little bit of downside risk in our projection, but there's also, I think there's a lot more upside risk in USDA's projection right now than there is downside in ours. So I think that the ultimate number will be someplace between those two numbers, but I think it ultimately will probably be closer to ours. Last week we got the monthly NOPA crush report, and that showed, surprisingly, after several months of significantly lower than expected crush, or at least lower than expected crushing volumes that were above expectations by about 4 million bushels. That I think reflects maybe a little bit of strengthening in meal demand. You've seen oil share has come down to around 45%, or maybe just a little bit below 45% today. And I think that reflects maybe a little bit of a pickup in meal demand, given that move and what we saw in the NOPA numbers. Their stocks number for end of August soybean oil inventories for their members also came in above expectations. It was about 100 million pounds above market expectations, which is we were about where the market was for both the crush and for soybean oil stocks. It didn't really, because of the larger crush, it didn't really have a big impact on our outlook for domestic use or non-biofuel use. The larger supplies essentially fell to ending stocks, and so we didn't really make any adjustments in our forecast based on the NOPA data. There's only a couple months left in the 2021 marketing year, a couple months of data left in the 2021 marketing year anyway, and about a week or so left in the actual marketing year. So we're pretty much confident in what the marketing year numbers look like. They may vary a little bit here and there, but this isn't a time where we typically make big changes in our old crop balance sheets. Now, our new crop balance sheets, again, the big question that I have and what I continue to struggle with is, where does the non-biofuel supply come from, especially given what we've seen in canola production in the US and Canada, and other veg oil production, sunflower production to a lesser extent in the US. Sunflowers are essentially grown in the same place canola is grown in. And so it becomes very tough to try to supply enough non-biofuel vegetable oil. And I think that ultimately what that means is that you get sort of an increase in the longer term, you get an increase in canola oil imports that may not pan out so much this year, but you get an increase in canola oil imports for the food industries, and you get potentially an increase in palm oil imports for feed industries and non-food industries. And again, we've heard for a while now anecdotal reports suggesting that palm oil imports into the US from Indonesia and Malaysia have risen in the past month or so. Cargo data out of Malaysia at least doesn't really bear that out. It still is kind of relatively about the same as it has been, kind of. But I think that's part of the longer term solution. And then the big question is, will imports ultimately be closer to our number of over 1 billion pounds, or will it be closer to USDA's number of 450 million pounds, which, as you can see, again, they cut in their latest supply and demand estimates. That question is important, because if it's our number, then the US becomes a net importer of soybean oil. And we might be a year early on whether we become a net importer of soybean oil, but it becomes really, really difficult to try to get the balance sheets to work without the US becoming a net importer of soybean oil over the next several years. And I think it's something that I can say with relative confidence that it's going to happen, assuming that the renewable fuel program continues and in the capacity for renewable diesel continues to expand in the way that we expect it to. I think that that's important because so far, really, the renewable diesel industry has not had the same conversation that we had when the ethanol industry built out. When that occurred, there was a lot of talk about sort of burning food for fuel. So far, that hasn't occurred in the renewable diesel industry. But I think that the shock of the US becoming a net importer of a commodity like soybean oil. Of course, we import a lot of commodities, but for agricultural commodities, generally tend to think of ourselves as net exporters. I think that shock may trigger that conversation. And of course, it also begs the question of what ultimately will happen to the 19% tariff on US soybean oil imports. Right now, I know that that the energy industry is lining up to lobby against that. Obviously, the farming industry will lobby to keep that in place. I have no special insight into ultimately who will win that war, I guess. But I think if we start to have this conversation about burning food for fuel, then that makes it somewhat easier for farmers to kind of say, hey, we need protection and we need to keep prices higher so that it will encourage us to plant more. Although, again, if you look out, this year we planted as much acreage as we've planted in at least the past 10 years. And if you go forward over the next couple of years, it looks like acreage is going to need to expand a bit to keep up with the demand for renewable fuels. The one wild card in this whole outlook is kind of the adoption of cover crops, as oil bearing cover crops to be used for feedstocks. I tend to think that is less of a solution than I think a lot of people think. But I think there are some people that believe that is going to ultimately, that's going to provide a substantial amount of the feedstocks that are required and will kind of be the solution to all of these issues about the US becoming a net importer and that kind of thing. I think we're a really long ways away from those crops contributing enough feedstocks to really solve the problem. And I don't see a pathway there, but mine is not the only opinion on this, and there are people that do believe that that is possible. Moving on to canola. The biggest news last week really was Stats Canada's latest canola production assessment. They put one out last month, and that one was mostly survey based. This one uses more objective data. They use satellites and things like that to gauge production, and they cut production by about 2 million tons to 12.78 million, which was about 2 million below our expectation and was about 1.5 million below market expectations. Market expectations were around 14.1 million tons. So a bigger cut, and it shouldn't be a surprise that it was a bigger cut given the weather that they had up there during the growing season, but a bigger cut in production than expected. So in response to that, what we did is we lowered our forecast for exports by I think 1.2 million tons to 4.5 million tons anyway. And that would be the lowest exports that we've seen since 2004-05, I think. And as a percentage of production, it's the lowest exports that I have in my balance sheets, which kind of go back to 93, 94. There may have been a lower percentage of production exported before that, but so for at least 25 years or so, historically low one way or the other. We did trim our crush forecast a little bit by 200,000 tons. Over the past couple of weeks, we've started to see the seasonal increase in weekly crushing volumes that are reported by COPA. And while we've sort of bounced off the seasonal lows, we still are running at a pace that is a little bit behind the record pace that we saw last year. It's not that far behind, and so that gives me confidence that that we're generally on the right path with this idea that that the cut in production is really going to weigh more on exports than it's going to weigh on domestic crushing. But we'll kind of see where we end up with that. I think one of the more interesting questions as you continue to cut exports really is that, okay, if we can crush 9.6 million tons domestically, obviously that mitigates the impact on Canadian canola oil production, the amount of supply that's available to export to the US, and also to use domestically. But what it doesn't solve is what happens in the countries that are importing canola seed. So they import canola seed, obviously, to crush, primarily for vegetable oil. And China is one of their largest consumers of canola seed, despite the political tensions that they've had in some attempts by China to reduce the imports of Canadian canola seed. They still remain a pretty big buyer. And if you remember last year, at the beginning of the year, right after the pandemic, as we came out of the pandemic lows, it really was vegetable oil shortages in China due to drought in the Black Sea region that reduced sunflower exports to China, that kind of kicked off the whole rally in world vegetable oil prices. Now, ultimately, then interest in renewable diesel and early renewable diesel plants opening up kind of kicked that into turbo mode. But the initial spark was really the Chinese shortfall. And at one point last year, they went down to Brazil and bought just a huge amount of Brazilian soybean oil relative to what they typically buy from Brazil. And if the canola exports are going to drop by as much as we expect them to drop, 6 million tons, that's going to leave some pretty big holes in vegetable oil balance sheets that ultimately are going to need to get filled in. So that backdrop kind of continues to support the bullish case for world vegetable oil fundamentals and contributes to my outlook for soybean oil prices. Because even if you think that renewable diesel demand or biofuel demand more generally will be weaker than expected and weaker than we think, at some point, then that would probably encourage US exports. Now, I don't think anybody really thinks that that's going to happen in any significant way this year, but there are going to be importing countries that are looking for vegetable oil supplies because of the sharp decline in Canadian production and Canadian exports. The only other change we really made here was we cut our ending stocks number from 750,000 tons to 500,000 tons. Now, we had, they recently released their quarterly stocks estimates, and end of the marketing year, stocks came in at 1.76 million tons, which was well above what we expected. I think we were at 500 for 2021, and maybe we had bumped it up to 750, but the number still is well above what we expected. If this number, if that sort of carries over into the new crop, then potentially this could be substantially higher than we're projecting right now. However, this residual use number, it kind of helps balance that out. So if stocks are ultimately higher, it probably means residual use will be at zero or potentially even negative for the new crop. I don't know that if you told me the answer to the question, if you said, hey, I know what ending stocks are going to be next year, and they're going to be 1.7 million tons again, I don't know that that would necessitate a cut in my forecast for crush or for exports. I might take a tiny little bit out of both of them, but I think I would let the bulk of whatever change in ending stocks implied, I think I would let the bulk of that fall to the residual use. And we've had fairly large negative residual uses in the past. They are unusual, but they do tend to occur more frequently if stocks are kind of tight, I think. we didn't really make any significant changes to our canola oil balance sheets for Canada. Again, we just made a slight adjustment in crush, and so the rest of this pretty much kind of stays as is. For palm oil, has been kind of interesting. The MPOB report showed a much larger than expected ending stocks number for the end of August. And it was well above market expectations and like 25% above the prior month, in part because while exports were weak and kind of came in line with market expectations, production jumped quite significantly, much more than it typically does from July to August. And so that was a big contributor to the larger than expected stocks. For a minute, it looked like we might drive old crop ending stocks up to that kind of magic 2 million ton number. But then we've gotten some changes in Indian import tariffs, and that has helped spur demand from India. We've also seen growth in Chinese import demand, so substantial growth at least through the first 20 days of September, substantial growth in Chinese import demand. And so we raised our forecast for Malaysian palm oil exports to 16 million tons, which is about 250,000 ton increase. And that took us back from the brink of the 2 million ton level. Palm oil prices have kind of been range bound around 4,100 ringgit, call it. Yesterday, obviously, with the concerns about Evergrande and what that might mean for the wider Chinese economy, palm oil prices tested 40.50, but then after the cargo surveyor data came out, they trimmed those losses and ended up down only sort of 2%. Nonetheless, that the default of Evergrande and the potential ramifications for the Chinese economy are likely to weigh on the palm oil market, at least in the short term. Ultimately, I think that that there's a lot of ways to look at this, and most of them end up either being sort of no big impact on palm oil demand, or if anything, potentially even sort of raise palm oil demand if you have sort of a sharp economic contraction and people need to tighten their budget significantly. They may shift from soybean oil to palm oil. So I think that the weakness that's going to be associated with this ultimately may prove to be an opportunity for maybe for U.S. buyers to start importing palm oil. The other thing that the market is kind of focused on outside of China and exports is obviously production. After last month's big increase in production, we expect it to kind of taper back to the sort of the normal month-over-month increase from August to September. And production typically peaks in September or October and then kind of falls through February or March. So we think that while people remain concerned about production, even though we had this big jump in production last month, we think it's probably going to be much closer to kind of normal levels. There still are some concerns about labor shortages, although those have improved a bit with the improvement in the coronavirus. I think those will continue to improve ultimately. And next year, assuming that that the coronavirus remains under control, then I think we could see a bounce back in Malaysian production and exports. I don't think that we necessarily see a big jump in stocks, because I think really India and China both will need to restock, and the move by the Indian government to cut tariffs on vegetable oils really suggests what's going on in the country, and sort of how tight their stocks kind of are right now. So at some point they're going to need to restock. It looks like that has started based on the cargo surveyor data for the first 20 days. But even if they have started, I think they probably have a ways to go. So I think that there will be enough export demand, growth in export demand next year to offset a substantial portion of any increase in production that we do get as sort of life potentially returns to normal. Our price forecast really did not change at all from last week. They really are the same that we had last week. Obviously, soybean oil is at the lower end of our range, and we may need to adjust that if prices continue to move lower. But I don't. Again, I'll say it. I don't expect them to move sort of substantially lower from here. And then I think this or sometime between now and December, we really hit the low for the next 6 months, and then prices start to build in anticipation of that big increase in renewable diesel production and capacity. All right, we also got EMTS data from the EPA last week, and that came in pretty much for a lot of things that came in kind of as expected and surprisingly close to our numbers, I guess I would say. The one area where we really were surprised was another increase in renewable diesel production to a record level of about 75 million gallons. That was about 10 million gallons above what it was the prior 2 months, basically, and suggests that we've either had more capacity come online, either in the form of a new plant or a plant that was sort of ramping up production, has ramped up production a little bit more. Either way, it kind of fits in with what we thought capacity expansion would look like. Now, we had trimmed that back a bit just because earlier in the year, production was coming in a little bit below where we were expecting. But now this week, we kind of added back some of what we had taken out to get a tighter correlation between capacity utilization and what we think capacity is going to look like over the balance of the year. You can see that the August number still it came in generally in line with the trend during 2021. Again, this isn't the tightest relationship that you've ever seen in your life, but in general, the trend is there, and we expect that that the HOBO spread kind of continues to move more in the favor of profitability for renewable fuel producers, and that should help bolster production over the balance of the year, along with just sort of the typical seasonal effect that we get as we near the end of the RIN compliance year. Now, this year, obviously, there's a lot of uncertainty about what the RFS mandates actually will be. And so the seasonal impact that we typically see, where production in December is typically the record for the calendar year, I don't know that will be that big this year, and it will really depend on whether companies that are carrying compliance deficits decide to meet those deficits, or they decide to carry them forward, or how much of their deficits they decide to carry forward. Now, RIN prices have come down, and so it may be that companies that were kind of on the fence about carrying compliance deficits forward may decide to either buy the RINs or buy the biofuels so that they don't have those deficits. And if RIN prices continue to move lower, then I think that choice probably becomes easier for them. In terms of margins, we have margins kind of heading lower from here, in part because we expect that this is kind of the low in feedstock prices, and we don't necessarily see a lot of big increase in energy prices going forward. The the tight correlation between renewable diesel and biodiesel, I think, is more a function of the feedstock mix for each of those, with biodiesel 75% soybean oil and 25% yellow grease, and then renewable diesel, a mixture of tallow and DCO and something else. Tallow and DCO, it's 50% tallow, 25% DCO, and 25% UCO. That's the other one. So I think that just because, again, we kind of have stretched the supply of the low CI feedstocks, Ryan has projected low CI prices that are probably higher relative to soybean oil than we've seen in the past. And I think that's probably has more to do with this chart that you see here than any sort of view on the relative profitability of renewable diesel versus biodiesel. Once you add in the credits, then the chart looks a little bit more like what we're used to seeing, with a big gap between renewable diesel and the biodiesel margin. Interestingly, biodiesel still remains, at or below negative margins. We should start to see rationalization at some point, but last month's EIA data still kind of reports that biodiesel capacity is holding in there. It's below where it was a year ago, but it is on a month-to-month basis. You really don't see any significant change. And I think, if anything, it's come up just a very small little bit over the course of the year. Now, I don't know that that's the most accurate assessment of biodiesel capacity, but it is an assessment of biodiesel capacity that we can kind of use as a gauge going forward. All right, RIN prices. RIN prices have continued to come lower as the market kind of digests this idea that that when the Biden administration does ultimately release the RVOs for 2021, that ethanol production probably is going to be, or the ethanol mandate is probably going to be closer to ethanol production levels than it is to the 15 billion gallons that we've seen over the years. You can tell that's the case because you can see the spread has gone from less than $10 to about $20. And that spread really is the indicator that the RIN prices are, that spread really is a function of the market's fear that we're going to run into the ethanol blend wall, that we're not going to produce enough ethanol to meet the mandates. And so as that concern goes away, that spread widens, and that has been the biggest contributor to the weakness in RINs. We expect that will kind of continue. All of that is really dependent on when they ultimately release the RVOs. If the RVOs don't get released until late next year, I think the market's going to continue with the same assumption. If they release them and the ethanol mandate is 15 billion gallons, I think you would see RIN prices shoot up and that spread narrow pretty dramatically, really, really quickly. If they release them and it is as expected, then I think you probably will have some stabilization in RIN prices ultimately, and then maybe a move higher depending on what the supply of biodiesel and renewable diesel looks like relative to those mandates. So our forecast here is a little bit of weakness, and then we get basically stable prices is what I would really say. We forecast this based just on a model, and the model picks up on some things sometimes, but what I would say is maybe we get a little bit of weakness here in the near term, and then kind of sideways to potentially higher, again, depending on what really happens with the RVO release. The HOBO spread forecast, Again, the HOBO spread has come back down, and if you look at the nearby contract, I'm not sure why this is still dotted, but if you look at the nearby contract, it's around $2 right now. We think there's a little bit more weakness again, potentially with some weakness in soybean oil prices, although our soybean oil forecast kind of goes steady to higher, but there's some potential for a little bit of weakness in soybean oil, at least a little bit of weakness relative to energy prices. They could weigh on our RIN forecast here through the end of the year, but then we expect RIN prices to start to move back higher again. Ultimately, that's based in part on our assumption of what the mandate will be for 2022, and so whether we get that support for prices will ultimately come down to exactly what the mandate ends up being. All right, and LCFS credit prices have kind of run the same way. They've kind of been lower, and we expect that that they will start to bounce back. You know, that said, we've kind of expected that this whole move down, and at some point they're going to have to catch. I still think the long-term value of LCFS credit prices is probably a little bit higher here, somewhere between 190 and 200. But at least in the short term, we're trading around 160, 170 right now. All right, I think that was everything that I wanted to cover. Let's see, let's answer. We got some questions, and if you have any questions, please feel free to type them into the Q&A section or into the chat, and I will answer them with, well, we're already over with whatever time we have left here. So this question is, P66 first phase renewable diesel conversion in California was just challenged. Do you think that their larger conversion and others in California are at risk, and how would that impact your demand forecast for feedstock oils? I don't know that that I think a lot of the others are potentially at risk. I don't know anything that makes Phillips 66 significantly different. I do know that in California, you get a lot more not in my backyard kind of challenges than you do in other areas of the country. And so I'm not sure whether this is ultimately a function of that or whether it's not. This is really a question that that Bob Lane can address in much better detail and with a much more thoughtful answer than I can. So if whoever asked this question, if you will reach out to me, if you'll send me an email, so Tori, T-O-R-E, Alden, ALDEN @fastmarkets.com. Send me an email and I will I'll talk to Bob and I'll hook you up with Bob, and I think he can provide a much better answer than I can probably provide for you right now. Sorry about that. Why do you expect LCFS prices to increase with the new renewable diesel starting this fall and all going to California? So if you look at the overall LCFS credit market, what you find is that the amount of the LCFS credit bank that is represented by transportation fuels is actually relatively small. And so the LCFS program, I think, is not generating credits at a pace that it looks like to us will keep up with the continued reduction in the carbon, the carbon, however you want to say it. I can't think of it right now, but in the reduction of the carbon that's allowed in the fuels. And because the electricity industry in particular has been a little bit slower, I think that that is going to dwarf the increase in the renewable diesel production. I also think that California was relatively, when they designed the program and set this up with the way that they made it more difficult to generate credits as you go forward for the same kind of activity. So if you're producing renewable diesel out of soybean oil, 1 year, the next year it's going to be a little bit, you're going to generate less credits than you did the prior year, or less valuable credits anyway. And I think less credits too, actually. And so because of that, they were expecting EV adoption to be substantially above where it actually has been. And so there are kind of some structural deficits that are built into the market that I don't think the prices are currently reflecting. Now the current prices are reflecting what's going on this year. And really, we think that next year and kind of going forward the following years, we think that that's when these sort of structural deficits are going to start to overtake the amount of renewable diesel that is produced. We will get a big increase in renewable diesel in the credit generation associated with that, obviously. But ultimately, that is if you think about it, transportation fuels are a relatively small piece of the overall energy pie. And that's what the LCFS is really focused on, is that the overall energy mix. And I would say that the transportation fuels are probably outside of the electric vehicle issue. The transportation fuels and the build out of that capacity is probably a little bit ahead of where CARB had expected. But you have these other areas where it's below, like EV adoption, and those just turn out to be bigger than the increases that we're going to get from renewable diesel. At least that's our view right now. Now we'll see whether one, we get all of the renewable diesel plants that we expect to, and two, if we don't get much better EV adoption in the coming years with the introduction of electrically powered trucks and pickup trucks and that kind of thing, it may be that that right now we're a little bit more bearish on EV than ultimately will turn out to be the case, or than that we've seen in the past couple of years anyway. All right, that is it for this week. Thanks as always for attending. If you have any questions or you need anything, please feel free to reach out to me at my email address. And outside of that, I will see you all in a couple of weeks. Have a great week, everybody.